It's Bob Hoopsher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. From March 2022 to July of this year, the Fed raised rates by 500 basis points. But the economy has done well this year with GDP growth of 2%, 2.1%, and 5.2% in the first 3 quarters. Does that mean the lagged impacts of the Fed's aggressive monetary tightening cycle will be fully felt in the year ahead? Is a second wave of inflation a major risk? The answers to those questions have implications for equities as the economic environment is likely to be volatile. Jeff Schulze is a managing director and head of economic and market strategy at ClearBridge Investments, overseeing capital market and economic research and contributing thought leadership on those topics to the institutional investor and financial advisor communities. So, Jeff, welcome. Tell me about your career path, what led you to ClearBridge, and a little bit more about your role there.
Well, thanks for having me on the program, Bob. And my career started back in 2006, coming out of Rutgers University. Started off at Lord Abbett, stayed there for about 8 years, got my CFA during the global financial crisis, and transitioned over to ClearBridge in 2014 for a new opportunity, and stepped into the head of economic and market strategy role in 2016, at which point I developed the firm's Anatomy of a Recession program, which is a program that features a dashboard of 12 indicators that track shifts in the US economy and could signal increased recession risk. And since that time frame, we've attracted a loyal following of over 150,000 financial professionals, both in the US and globally. And I think the key differential of this program is that it provides timely analysis of the connection between equity markets and the economy.
So, what is the recession dashboard saying now? And talk a little bit about the input and the analysis that goes into it and that it contains.
So, as mentioned, 12 variables that have historically foreshadowed a looming recession is the dashboard. It's a stoplight analogy where green is expansion, yellow is caution, and red is recession. And at the moment, we have 0 green, 3 yellow, and 9 red signals. But I think more importantly, we continue to have an overall red signal in the dashboard, which signals heightened recession risk. And when you look at the dashboard historically, the data goes back to the early 1960s. We've had 9 overall red signals in the dashboard's history, 8 of which were recessions. We had 1 false positive in 1967. Now, I'll say that's a good false positive, if there is such a thing as a good false positive, because it was early on in the dashboard's history, so we didn't have a lot of data. And quite frankly, we've had 8 recessions and 55 more years worth of data to make the dashboard smarter. But in looking at those variables, 5 of the variables look at the consumer specifically, 4 of the variables look at business activity, and then 3 variables look at financial indicators.
3 yellow, 9 red, red overall. What time frame does that forecast? In other words, do you expect a recession in the first quarter, the second quarter, at some point in 2024?
Well, this is the longest red signal that we've had in the dashboard's history. The previous longest red signal was ahead of 1990s recession, and it came 13 months prior. But I think there's been some key supports of the economy that has kind of prolonged this cycle. But I think as we look forward, I think that the toughest part of this expansion's journey is going to be in the first half of next year, where the lagged effects of Fed tightening are going to be fully felt by the economy at the same time where key supports like fiscal stimulus and a resilient consumer start to fade. So we're really looking at the first half of next year for the heightened risk of a recession. And if it doesn't happen and the economy can hold up, we're going to be more fully embracing that soft landing narrative, but we're not there yet.
Talk about inflation. What is your data telling you about pending inflation? And specifically, I know the Fed looks at the PCE index. What are your thoughts around that?
Well, inflation has come down remarkably fast. Looking at the PCE index, which doesn't look at a basket of goods like CPI does, it looks at what consumers actually buy. So, for example, if the price of chicken spikes up dramatically and consumers substitute buying chicken for beef, the PCE index is going to capture that change of preference. So it's a better measure of what people are actually paying. And there's two ways to look at it. You can look at headline PCE or core PCE, which strips out volatile areas like energy and food. And the Fed prefers core PCE. But I think maybe more importantly, if you look at the 3 month annualized number for core PCE, it's coming at 2.5%. The 6 month annualized number is 2.6%. So we're a stone throw away from the Fed's target. But last month, core PCE came in at 0.16 on a month over month basis. And if you times that by 12, you're right at the Fed's 2% target. So investors aren't really looking at more hikes at this moment. They're really shifting their view into when's the first cut going to come in 2024.
So we're getting very close to the Fed's 2% target on PCE. Now, Jerome Powell has said that he prefers to look at the PCE index excluding shelter. What was the reasoning behind that? Is he still doing that? And do you agree? Is it appropriate?
I do agree that it's appropriate. I mean, you want to be very careful. The idea of core inflation it came out in the mid 1970s as a way to kind of strip out how high inflation was to the public. Because if you look in the 1970s, inflation was really being driven by food, oil, and labor shocks. So you don't want to strip out too much, but I do think that there's some validity at looking at core services PCE that strips out shelter. Because if you look at the correlation between that and wage growth, very strong correlation overall, and wage growth tends to drive demand and ultimately inflation. But I think good news for the Fed and investors is if you look at this super core measure, came in at 0.15% on a month over month basis with the latest release on a year over year basis. It was the lowest number that we've seen since 2020. So inflation is clearly slowing, which again is good news for the Fed and the potential for this expansion to continue.
So we're talking about wage growth. Let's talk about unemployment. What's the correlation that you've seen between unemployment and rate cuts, and how does that compare to the historical data that you've been tracking?
Well, there's really two types of rate cuts out there. There's rate cuts that fine tune the stance of monetary policy. Monetary policy, the way that it's judged is if you look at the Fed's funds rate, you compare it to inflation. If it's below inflation, the Fed is accommodative. If it's above inflation, the Fed is restrictive. They're slowing the economy. So if inflation does move lower over the course of 2024, if the Fed does nothing and just keeps rates where they are, that's a de facto tightening. And that's something probably that the Fed wouldn't want. So the Fed would cut one or two times in that environment. The second type of cutting cycle is a recessionary cutting cycle where the Fed needs to get stimulus to the economy. Again, generally speaking, you're going to see much more chunkier, larger cuts in that type of situation. But generally speaking, a lot of times the Fed, when it's cutting, it's because a recession is on the horizon, and the Fed usually cuts 5 months after the last rate hike. So usually that pause period is a lot shorter than people anticipate.
So if we want to look at what the end of the rate hiking cycle period was, we have to look at how long that we've really been in that restrictive territory. Now, I said in my introduction, the Fed started its cycle in March of 2022. Is that really the right way to measure the length of this restrictive territory in monetary policy?
It really isn't, and I think a lot of investors, really don't take this into consideration. So, as I mentioned earlier, the way to tell whether or not the Fed is restrictive or accommodative is to look at inflation and the neutral rate, which is about 50 basis points. That's the hypothetical interest rate where the Fed's neither helping or hurting the economy. And again, if the Fed funds rate is below those levels, the Fed is helping the economy. If it's above those levels, the Fed is slowing the economy or in restrictive territory. And given how far behind the Fed was behind the curve, the Fed had a lot of hiking to do in 2022 in order to just get to restrictive territory. And we like to use a 1 year inflation swap as our proxy for inflation because businesses and consumers make decisions based on what they think prices will be. not necessarily where they've been. And in this, using this metric, I mean, the Fed's only been in restrictive territory for a year. So it really shouldn't be a surprise to anybody why we haven't had a recession quite yet.
There's still a lot of talk about the soft landing narrative versus a recession. You spoke about that earlier. You think that if we can make it through the first half of next year, we'll be okay. What additional thoughts do you have around that narrative?
Well, the reason why I think this is the toughest part of the journey is that the economy is going to feel that restrictive policy much more aggressively over the next 2 to 3 quarters, right? Because if you look at the deficit as a percent of GDP from the summer of last year to the summer of this year, it went up by over 4% or $1 trillion. So even though the Fed was in restrictive territory, all of that fiscal stimulus was negating what the Fed was trying to do. So with the debt ceiling agreement that came into place recently, that's going to cap discretionary spending over the next couple of years. So that tailwind to economic activity, that fiscal impulse, is no longer going to be there over the next couple of quarters. So that's one reason why I think we're going to see actually the effects of what the Fed has done, its cumulative effects over the next couple of quarters. Also, what's going to start to curtail credit creation is tighter lending standards. Now, when you look at the Fed senior loan survey, lending standards to businesses and consumers went net negative at the beginning of 2023. And usually the lags on lending standards and having an effect on credit creation is anywhere from 9 to 18 months. So again, you put that lag on, we're next 2 to 3 quarters likely going to start to feel the effects of tighter lending standards. And I think maybe more importantly, in the three soft landings that the Fed's been able to engineer since the 1950s, in each of those instances, lending standards to businesses and consumers are actually quite loose. There is a willingness to lend out into the economy. And right now, lending standards are at recessionary territories. So I think, if we can get through the next couple of quarters, and even if the economy grows below trend, but we don't go into a recession, I'm going to feel much more better about the prospects of a soft landing. But I really just don't think we're there yet.
We're in a fairly unique set of circumstances. You mentioned earlier how we've had strong GDP growth despite restrictive monetary policy. We've also had low unemployment, but rising deficits. The deficit, I think, is about 6% of GDP. If we do face a recession, what will be the impact on unemployment, and what will that then mean for the deficit?
Well, yeah, we're in rare times. Generally speaking, you could go all the way back to the 60s. When you have a low unemployment rate, you have a small deficit because you have strong tax receipts and there's lower need for social safety spending. Conversely, when you have a high unemployment rate, the deficit gets bigger because tax receipts go down and there needs to be some sort of stimulus to bolster the economy. But that relationship is broken down over the last two cycles. So again, what I mentioned in the previous question. But I think more importantly, if you look at the last 8 recessions, typically the GDP ratio has worsened by 5.2% on average. But in the three most recent recessions, those numbers have been negative 13%, negative 9%, and negative 6%, respectively. So if we have a recession, you're going to see the debt to GDP ratio move even higher than what we've currently experienced. And coming back to your initial question about unemployment, typically the unemployment rate rises since 1948, so the last 12 recessions, by 4.1% in a recessionary outcome. Now, the lowest that it's ever risen was in 1960 at 2.3%. In the dot-com bubble recession, the unemployment rate rose 2.5%. I think that's probably the region that we get into just because there's not a lot of excesses in the economy and there's clear signs of labor hoarding after 3 years of labor shortages. But ultimately, you're likely going to see the unemployment rate rise if a recession materializes, and the deficit's going to continue to get bigger from here.
And we're at what 3.8 or 3.9% on U3 unemployment. That would put us in the at least in the 6 to 7% range.
Well, as of this morning's payroll release, we're at 3.7, so we dropped down a couple tenths of a percent. But yeah, we'd be looking at high fives, low sixes when all is said and done.
Overall, what do you see the trajectory of the economy looking like as we head into 2024?
Well, the payroll print that we got today alleviated some of my concerns that we're going to get our first negative payroll print in the first quarter of next year. Really strong survey. You saw some key areas start to pick up, whether it was hours worked. You saw some strong numbers coming out of the household survey, which was diverging from the headline survey that you get from the establishment report. But I think as we look forward, I think a lot of people tend to focus on what happened in the past. Now, in the third quarter, real GDP growth was really robust at 5.2%, but that doesn't tell us anything about the first half of next year because when recession contagion takes over, the economy can turn very quickly. So, looking ahead of the last eight recessions, 3 quarters prior to the start of those recessions, real GDP growth was 4.6% on average, so a stone throw away from what we saw in Q3. 2 quarters prior, that drops to 3.5%. And then 1 quarter prior, you see a sharp deceleration of economic activity as that recession contagion takes over and the economy barely grows at 0.8%. And this reminds me of the novel by Ernest Hemingway, The Sun Also Rises, when the main character, Mike Campbell, was famously asked, how did you go bankrupt? And he said 2 ways, gradually and then suddenly. And the same thing tends to happen when a recession takes over. And when you look at the Atlanta Fed's GDP Now number, which is a nowcasting tool, essentially looks at all of the data releases for Q4 and says, if it came out today, what would GDP be? It's at 1.3%. So you've already seen a step down in economic activity. So we're expecting that moderation to continue. And again, we may or may not have a recession, but I'm going to feel a lot better about that soft landing outcome if we can get to the third quarter of next year.
Great. And I should mention we are recording on December 8th, and I thank you for getting that data on this morning's unemployment report, which I had neglected to look at. So thank you. We've talked about the economy. I want to touch on what that means for the markets. And if there's a key takeaway that you'd like to leave with our audience of advisors about how they should position their portfolios heading into the new year, what would that be?
Look, in the post World War II era, the average recessionary drawdown has been 29.9%. Let's just call it 30. I don't see a lot of obvious excesses in the economy. A lot of stocks outside of the Magnificent Seven are priced pretty, modestly. They're embedding some skepticism, some fear of recession in those multiples. So if we have a recession, maybe the economy drops, maybe the S&P 500 goes down 15 or 20%, but I don't see it really moving further than that. But I think it's more important to note that we believe that we're in the midst of a secular bull market in the US. So if you look over the last 100 years, usually the market goes nowhere for about 10 to 20 years. That's known as a secular bear market, but they're always followed by a 20-year period where you have substantial upside in US equities, better known as a secular bull market. And our view is that we exited the secular bear market of the 2000s, and we're in year 13 of 20, where you have outsized gains in US equities. And I think as we get through this potential recession, should there be any material sell off, strongly advocate to add to your US equity positioning. And I think from an asset class perspective, I think dividend growers look like a really good asset class to kind of hide out in as we move through this potentially choppy period. They're a lot cheaper after this move into cyclicality that we've seen and stronger growth that you've seen this year. But also, they're high quality companies. They have high earnings visibility. These are all attributes that investors covet when the earnings picture starts to get a little bit less visible.
Well, wonderful. And we'll include some links in the notes that accompany this podcast. We can learn more about Jeff and his team at ClearBridge. There'll be two blog posts that Jeff has written. One is called The Fed is Done, What's Next? And the second is Not Always a Straight Line Down. And then there's a podcast that Jeff did called Economic Outlook 2024, The Year of Lagged Effects. Jeff, is there anything else that you'd like to add?
No, just want to say thank you to Advisor Perspectives and Vetify and Bob, you for having me on the podcast today.
You're welcome. And thank you for listening to the Gaining Perspective podcast with Bob Hoopshire, today featuring Jeff Schulze of ClearBridge. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.